This session we will cover payout policy, okay, which is the second main driver of capital structure policy, actually. Later, we'll realize that a lot of the lessons with respect to payout policy actually is also applicable to dividend policy, and also to capital structure policy. They are interrelated. So today we'll discuss more about the payout policy. Okay? So when we talk about payout policy, we are looking at distributions to shareholders. That is really the main topic, with respect to payout policy. When there is free cash flows to equity, okay, those cash flows can either be retained by the company or paid out in terms of dividends. Okay, the decision of how much to retain and how much to pay out forms part of what is dividend policy or payout policy. Okay? Uh, in the past, this topic has been characterized as dividend policy, yung usual title in the past. But more recent literature actually says that when we talk about distributions to shareholders, there are two ways on how to distribute that cash to shareholders or excess free cash flows. Okay? You can opt to pay it out using dividends, or you can opt to pay it out using repurchases or share repurchases. So the policy of how much to give out, how much free cash flows to pay out, and the form of that payout, whether in the form of purchases, repurchases, or dividends, also form part of the payout policy. Okay. Now, of course, part of the payout policy's consideration is if and when the company retains cash or retains its free cash flow, there has to be a purpose why cash is being retained. So cash is being retained either so that you can reinvest it in new projects, or you are using it as financial flexibility. You want to increase the firm's reserves, cash reserves, so that you have the ability to use that money to invest in future new projects that it's probably not manifesting now. Okay, so this table, actually, this figure is actually very demonstrative on the decisions of dividend policy or payout policy. Okay, the idea is you have excess cash, excess free cash flows. To note, free cash flows to equity, meaning you have already paid debt and all debt obligations. And what is remaining, you know, are excess cash that you can either retain or pay out. When you pay it out, you have to decide whether it is through repurchases or dividends. Okay. If you retain it, you have to check whether it's through projects or to increase cash reserves. Okay. So essentially, that's what payout policy really means. Okay. The traditional way of paying out or distributing cash to shareholders is through dividends. Okay. And during the dividends, the process of paying dividends, we are looking at 4 dates. Okay. First is the declaration date. So the declaration date is the date on which the BOD authorizes the payment of the dividend. So in this example, this is Microsoft stock, okay, or the Microsoft board. No, the board declares a special dividend of 3 per share on this date, and this date is called the declaration date. Okay, so the declaration date will specify a specific record date and a specific payable date. Okay, now the record date, okay, is the date record date is the date where all shareholders recorded by this date shall receive dividends. Okay, so parang from the declaration date to the record date, there's time between the two. Okay, and by the time that it's also already record date, a list of shareholders will be generated at time of record, and whoever is in that list, okay, will receive the dividend by the time of the payment date. Okay. Now, of course, for the company to generate that list, dapat matapos muna yung mga transactions, right? So it doesn't mean that all shareholders actually, dapat ma-generate muna yung list of shareholders. So dapat merong time period, no, between the last trade, okay, para ma-determine yung listahan ng shareholders. Hindi naman real time yung listahan ng shareholders eh. Kasi when share transactions happen in the marketplace, there's a processing period, right? At after yung processing period na yun, saka lang ma-update yung shareholder list. Okay? That's why there is an ex-dividend date. Okay? So the ex-dividend date, okay, is the date wherein buyers of stock on or after this date shall do not receive the dividend. Kasi yung last transaction will happen on November 15, and the last transaction in November 15 will be processed so that it will be part of the shareholders list by the record date. And dahil nasa record date siya, then yung may-ari ng stock as of November 15 is the one who's going to receive the dividends. Okay? That's why the ex-dividend date is very important. Binabantayan yan, right? Because if you are trying to trade stock, okay, between the declaration date and the dividend date, no, owners during this time, okay, no, owners until November 15, whoever is the shareholder listing, okay, will be the one processed so that by November 17, it's part, you are part, or the investor will be part of the list of shareholders. Okay. So during this time, okay, during this time, from July 20 from declaration up to the ex-dividend date, the stocks are trading dividends on, or in the book, it's called cum dividends, which means with dividends. Okay? Kasi pag bumili ka ng Microsoft stock ng November 16, hindi ka naaabot sa record date. Kasi pag pinrocess yung ownership mo ng November 16, magiging stockholder ka as of November 18 record. So therefore, hindi ka part ng shareholders as of record date. But that's why knowing the ex-dividend date is important, because during the declaration up to dividend date, essentially, the stocks are trading with dividends during this period. And after the X date, no, they are now trading X dividends. Okay? Kasi hindi, kung sino man yung mag-trade from November 15 to November 17 will not receive dividends. Kasi wala siya sa record date. Okay? Now, in our book or references in the US, the ex-dividend date is 2 days prior to the record date. However, I checked that in the PSP, the ex-dividend date is 3 business days before the date of record. Okay? And this is important because the cash flows will be different, right? If you're an investor during this time period, okay, right? If you hold stocks by November 15, okay, then you will receive dividends. And since you will receive dividends, your cash flows are different, right? Than an investor that will purchase the stock after November 15. Okay. Now, the payable date or the distribution date follows afterwards. So generally within a month, so that after the record date. Okay, so at the payable date, the payments are going to be paid based on the listing generated during the record date. Okay. Now, some concepts on dividends. Okay. Special dividend. A special dividend is a one-time annual payment of earnings, which is usually larger than a regular dividend. A regular dividend, ito yung usual na parang the regular dividend rate. Okay. Now, if you want to pay something in excess, you call that a special dividend. Okay. What is a stock split? Okay. A stock split is not the same as stock dividend, but essentially, it is when a company issues a dividend. So, burahin na natin to. Okay. It's when a company issues a dividend in shares of stock rather than cash. So rather than sa payment date, rather than this being paid in cash, you give more shares. Okay. Property dividends naman is when a company pays dividends in terms of assets other than cash. So it can be shares of stock, meaning investments, okay, and receivables or property or inventories. That could be examples of property dividends. What's a return of capital? When a firm, instead of paying dividends out of current earnings, okay, or accumulated retained earnings, pays dividends from other sources such as paid-in capital or the liquidation of assets. So yung return of capital, nagpipay na siya on top of earnings or accumulated earnings, and therefore nagsusoli na siya ng capital. That's why it's called a return of capital. A liquidating dividend is a return of capital, so similar to that. However, the business is being terminated. Pasara na. That's why it's called liquidating. Okay? So it's part of the winding down operations of a company. Now, as I mentioned, another way to pay cash to investors is through share repurchases. Okay? So basically, the firm uses cash to buy shares of its own outstanding stock. What are some ways to do it? You can have open market repurchases, meaning the company buys shares in the open market. Okay? Open market share repurchases in the US represent about 95% of all repurchases. So just a normal transaction in the market. What's a tender offer? It's a formal announcement of an offer to all existing security holders to buy back a specified amount of outstanding securities at a pre-specified price at over a pre-specified period of time. So it's a formal offer. Usually, this is part of some corporate events. For example, there was a change in control. That can be a reason why there is a tender offer. Or there is delisting. That's one reason why there's a tender offer. Or simply they want to repurchase shares at a specific price. Okay. Targeted repurchase is when the firm purchases shares directly from a specific shareholder. So this is negotiated, and usually this is because of a block sale. Isang block ng shareholders wanted to sell. And usually, if there's a target repurchase and a block sale happen, it will trigger a tender offer so that minority shareholders are protected. Okay. A green mail is simply a type of share repurchase wherein the objective is to avoid threat of takeover. So that's when a firm avoids the threat of takeover and removal of its management by major shareholders by buying out the shareholder. Okay? Often at a large premium. So, kaya sa ma-takeover, bilhin mo na lang doon sa mag-takeover. Okay. Now, let's consider the case of Genron Corporation. So let's look at the dividend decision. Okay. So in this case, consider the case of the company, a hypothetical firm. They have excess cash of 20 million. Okay, and they have no debt. The firm expects to generate additional free cash flows of 48 million per year. And they expect that the 48 million is going to be paid in dividends. Okay. All excess cash will be paid out as dividends. Okay. The unlevered cost of capital is 12%. So therefore, if you compute the enterprise value of its operations, it is 48 million, which is the dividends that you're going to pay out, right? Over 12%, plus the 20 million cash that you are holding. Okay. So that's 420 million. Because this is 400 million plus 20 million. So that's the total enterprise value divided by 10 million shares, which is the shares outstanding. The current share price is 42 per share. Okay. What is the effect if the 20 million, okay, is going to be paid out as dividends. Okay, so let's look at that in terms of the point of view of the investor. Okay, so if there are 10 million shares outstanding, then Genron will be able to pay $2 of dividend immediately. Okay, and the firm expects to generate future cash flows of 4.8 million per year, and therefore dividends of 4.8 million per year. Okay, so the cum dividend price, okay, or dividends on price of Genron will be, the present value of all cash flows. So present value of future divs, okay, plus the current dividend kasi time equals 0 yan. So parang raised to 0, 1 over 12 raised to 0, which is 1. So that's why you can simply add it up. Okay? So having this, it's $2 plus 4.8, which is the dividends per share, over 12%, assuming perpetual cash flows. And therefore, the share price will still be $42. So versus the status quo, no divs. Okay. And the dividend scenario, there is no change in value, right? So therefore, you say here, under the first alternative, even if you pay out that excess cash, the value of the firm will be the same. The value of equity rather will be the same. What if we do not pay dividends, but we repurchase shares? Okay. So remember, our status quo is still 42 per share, right? No dividends, no action. Okay. So suppose that instead of paying a dividend this year, uses the 20 million to repurchase its shares in the open market. Now, ang initial share price currently is 42 without doing anything. So you can use that as basis. Okay? So you can purchase 476,000 shares. How do you get that? Okay. With your 20 million, buying 42 per share, $42 per share. Therefore, it results to 476,000 shares that you can buy in the open market. When you buy that amount of shares in the open market, the number of shares outstanding will be lower. It will be 9.4524 million shares per now, okay, with no impact on stock prices. But it should not be surprising. Why? Why is it not surprising that there is no impact on stock prices? Okay? With the lower number of shares, okay, after repurchase, the future dividends would rise to 5.04 per share. How is that the case? Remember, you are going to generate 48 million as perpetual dividends over lower number of shares outstanding, 524 million. So you have 504 per share divided by the cost of capital. You arrive at the same, okay, the same cost of the same share price, which is $42. So here, in the first example, alternative 1, we said that dividends no impact in share price, in status quo share price, okay, which is 42 per share, which is do nothing. Okay. In this second point, we are also seeing that share repurchases has no impact on stock price. And so therefore, there's no need to do it. Okay. So investors should be indifferent between dividends and repurchases because parehong walang impact. In fact, you should be indifferent versus no dividends also. Right? Because pare-pareho lang naman yung share prices. Now, what if they want to pay more dividends aside from $2 per share? Okay. So suppose Zenron wants to pay dividends larger than $2 per share right now, but it only has 20 million in cash today. So for example, they want to raise 28 million to pay the larger dividend now. So therefore, they want to have $48 million worth of cash that they can pay out as dividends. How do they do it? they can raise this cash by selling new shares, for example. Okay? If you do that, what happens? The current share price is $42. So therefore, they could raise 28 million by selling 0.67 million shares, so 670,000 shares. So 670,000 times 28, times $42 will give you 28 million. Okay, which is the same as this one. Okay. So with that, you're able to increase the number of cash, right? So that you have enough cash to pay for dividends. However, the number of shares increased to 10.67 million from the original 10 million. Okay. The new dividend per share will be 4.48 million, which is 20 original cash that you have plus 28 that you raised. Okay. Over 10.67 million shares, the new dividends per share will be 4.50. Okay. And with that, computing the home dividend price per share, okay, the dividend that you will receive now is 450. The dividend that you will receive from next year to perpetuity is 450 over 12%. So this is 450. This is 37.5. And so therefore, the price remains today at $42. Okay. So this is sounding familiar, right? This is similar to capital structure policy, right? And thus, we also have what's called the Modigliani and Miller dividend irrelevance theory. Okay? So you're saying that in perfect capital markets, holding fixed the investment policy of the firm. The firm's choice of dividend policy is irrelevant and does not affect the share price. Okay? Because even if you want to pay the normal dividend, not pay dividends, but do repurchases instead, or pay a larger dividend now at the consequence of lower dividends in the future, okay, it all boils down to the same share price. And so therefore, it should be irrelevant. In fact, versus status quo of do nothing, the current share price is still 42 per share. So do nothing versus dividends, repurchase, more dividends or high dividends, it's irrelevant according to Modigliani and Miller. Okay? But again, we know that Modigliani and Miller is only correct with respect to perfect capital markets. Okay? Payout is irrelevant under perfect capital markets, but again, we want to introduce additional capital market imperfections. And the first one is taxes on dividends and capital gains. Okay? Because the basic tax difference between dividends and share repurchases is for dividends, there's a tax on dividends. For share repurchases, there's a tax on capital gains. Okay, what is capital gains? Capital gains is simply parang cost, selling price. This is the gain, right? That is usually taxed. Okay. And of course, you can express other taxes in terms of that. Ang point lang, alin ba ang mas mataas ang tax? Dividends or share repurchases. Okay. So, in the US, dividends are typically taxed at a higher rate than capital gains. Okay. In fact, long-term investors can defer capital gains by not selling. No? You can opt to pay not. Pwede kung capital appreciation ka lang forever. Right? You don't need to pay dividends. You don't need to pay capital gains if you don't cash it. Right? But your wealth is increasing. Pero walang tax. Okay? So you can defer capital gains. When there's a dividend, you cannot defer the tax. Okay? So the higher tax on dividends make it undesirable for a firm to raise funds to pay dividends. Okay? When dividends are taxed at a higher rate than capital gains, if a firm raises money by issuing shares, then gives that money back to shareholders as a dividend. Shareholders are hurt because they have to pay taxes when cash is being returned to them. Okay? Kanina, di ba, we raised cash through equity kanina, right? And then paid it as dividends. And we said no stock price impact, no share impact, right? But if there is taxes, when you pay it as dividends, there's a tax. So the amount received by shareholders will be less than the amount that you raised from them, right? So there's a tax leakage, and therefore they are hurt because of that. Some of this value goes to the government due to taxes. Let's look at this example. Suppose a firm raises 10 million from shareholders and uses this cash to pay them 10 million in dividends. If the dividend is taxed at 40% rate and the capital gains are taxed at 15%, how much will shareholders receive after taxes? Okay. So shareholders will owe 40% of 10 million or 4 million in dividends taxes. So 40% is the tax rate, 10 million is the amount that's being distributed as dividends. Because the value of the firm will fall when the dividend is paid, shareholders' capital gain on stock will be 10 million less when they sell. Okay? Lowering their capital taxes by 15% of 10 million or 1.5 million. Okay? Thus, in total, shareholders will pay 4 million less 1.5 million, and they will receive back only 7.5 billion of their 10 million investment. Okay? So that is the key. If you look at this, when there's a raise, okay, shareholders pay 4 million, okay, which is 40% times 10 million. Okay. Now, the value of the firm will fall when the dividend is paid, right? Because some value will be paid to the government. Okay. The shareholders' capital gain on the stock will be 10 million less when they sell. Okay? Kasi dati yung 10 million nasa balance sheet, ngayon wala na. Right? And so the value will be 10 million less. Okay? Parang saving siya sa capital gains, and it's 15%. Okay? So that's why, in effect, there's a 1.5 billion capital gains savings. Okay? And so therefore, the net impact is 2.5 million. Okay? Not taxes. Considering the two. Okay? And since you were able to raise 10 million, okay, and then ibabalik mo sa kanila supposed to be 10 million, but however, they are actually only receiving 7.5 billion because 2 million will be in the form. 2.5 billion will be paid as taxes. Okay. So, what is the main conclusions here? When the tax rate on dividends is greater than the tax rate on capital gains, okay, obviously, shareholders will pay lower taxes as the firm uses repurchases rather than dividends. Okay, obviously. So, ayaw nilang makatanggap ng dividends. Gusto nila capital appreciation. Okay, because the taxes is low. Okay. These tax savings will increase the value of the firm that uses repurchases rather than dividends. The optimal dividend policy, when the dividend tax rate exceeds the capital tax rate, is to pay no dividends at all. Therefore, because mas makakatipid nga siya sa dividends, sa taxes. Okay, that is going to be shouldered by the shareholders. Okay. Now, however, you have to understand that not all people or not all investors are subject to the same tax rate, right? Individuals might have a different tax rate, corporations might have a different tax rate, or some entities by law may be tax-free, right? So therefore, actually, not everyone will have the same preference with respect to dividend policy, right? Kasi pwedeng magkakaiba yung tax treatment for dividends and capital gains for all of them, right? That's why one theory of capital structure is to measure what's called the clientele effect. Okay. And what is that? The preference for share repurchases rather than dividends depends on the difference between the tax rate and the dividend rate, dividend tax rate and the capital gains tax rate. However, those taxes differs across investors for a variety of reasons. Income level, pwedeng progressive yung taxation, meaning pag mas mataas yung tax payable, mas mataas ang tax rate. So that's one reason. Investment horizon. Okay? If the investment horizon ng isang investor is annually may kailangan siyang ibentang shares, so lumalaki yung tax burden ng capital gains tax, right? Rather than someone who's in it in the long term. Yung capital gains tax niya matagal pa, malayo pa. Present value terms, mas konti, right? Tax jurisdiction, no? The laws in Europe, US, Philippines are different. So the tax treatment are different, no? And the investor amount or the account. No? So in other words, different investors might have a different preferences in terms of the level of dividends due to tax differences. And so as a result of the different tax rates, investors will have varying preferences regarding dividends. And actually, you can sort of predict, okay, the type of investors preferring one dividend policy over another. Okay? Parang you can pull them together. And that is the clientele effect. Okay? Actually, there's a whole spectrum of different kinds of investors, okay, who are seeking different kinds of dividend levels. Okay? May mga types of investors na kailangan ng high dividends. May mga types of investors kailangan low dividends. Okay? And so ikaw, as the corporation, okay, you declare your dividends based on the type of clientele or investor base that you want to attract. Okay? So kung ang kailangan mong investor base, institutional investors, okay, then you probably need to skew your dividend policy into a certain way to attract them. Okay? And that's the clientele effect. So parang sinasabi is, actually, the dividend policies of different corporations are based on the kind of investors that they want to attract. And sometimes, most often, that is driven by dividends, tax rates rather. So when the dividend policy of a firm reflects the tax preferences of its investor clientele, then that's the clientele effect setting in. Okay? What is the general rule? Okay, individuals with the highest tax brackets have preference for stocks that pay no or low dividends. Whereas tax-free investors and corporations have a preference for stocks with high dividends. Okay? That's why if ang target mo retail, okay, they are tax disadvantaged for dividends, okay, and therefore they prefer share repurchases. So they would want low dividend paying companies. Kung ang target mo institutional investors and corporates, okay, there might be tax advantage for dividends and therefore they were preferring high dividend paying companies. Okay, so that's probably one driver with respect to dividend policy. What's the dividend capture theory? It's the theory that absent transaction costs, investors can trade shares at the time of the dividend so that non-taxed investors receive the dividend. Okay? At that time of the dividend, investors can trade shares at the time of the dividend so that non-taxed investors receive the dividend. So, for example, here's data on value line. When the dividend was announced at this time, the volume of transactions increased and the pricing also increased. Okay? So parang ang theory is during this time, nagkakaroon ng maraming announcement to, so declaration. Okay? Tumataas yung transaction volume, okay? Because driven daw yan by taxes. Because high tax investors want to sell and low tax investors want to buy. And that triggers the higher volume. Okay? In anticipation of the dividend. So that's why when ex-dividend happens, okay, bumababa na rin yung price, bumababa na rin yung volume of transactions. Okay? So that's a dividend capture theory. Okay? Now, another decision is to whether to pay out something or retain the cash. Okay? So as we know, in perfect capital markets, once a firm has taken all positive NPV investments, wala ka ng alternative use of the cash. Okay? It is indifferent between saving excess cash and paying it out. So yan, nabanggit natin yan under dividend irrelevance. No? With market imperfections, there is a trade-off now between retention of cash or payout of cash. What is the trade-off? Number one, retaining the cash can reduce the cost of raising capital in the future. So transaction costs. Okay. If I have the cash now, I don't have to spend for all the road shows, for all the regulatory costs, legal costs with respect to raising future capital. Okay, kasi nasa akin na yung pera. Okay. However, it also increases taxes and agency costs. Kung may pera, hindi merong opportunity for empire building in management. No? Kung may perang excess, hindi pwedeng hindi siya masyadong diligence operations. Marami namang excess cash in. Okay. Pag maraming pera, kailangan niyang invest. No? And therefore, pag kailangan niyang invest in, for example, money market investments or short-term investments, that incurs taxes. Okay. And also, excess cash is a form of negative leverage, right? Nababawasan yung impact ng leverage because of the excess cash. So those are the two things that is being balanced. If a firm has already taken all positive NPV projects, any additional project it takes on are zero or negative NPV projects. So it's a waste of cash. Okay? So rather than waste excess cash on negative NPV projects, the firm can use the cash to purchase financial assets and earn interest income, okay, and pay taxes out of it. But again, this is also considered negative leverage or counteracts the impact of leverage. So in perfect capital markets, buying and selling securities is a zero NPV transaction. So it should not affect firm value. So with perfect capital markets, retention versus payout decisions is relevant, but with the presence of these market imperfections, definitely payout and retention will have some impact on firm value. Corporate taxes make it costly for a firm to retain excess cash, because cash is equivalent to negative leverage, so it counteracts the impact of the tax advantage of leverage. Okay. The decision to pay out versus retain cash may also affect the taxes paid by shareholders. So let's look at these bullet points one by one. When a firm retains cash, okay, it must pay corporate tax on the interest it earns. So that's an outflow. Okay. In addition, the investor will owe capital gains tax on the increased value of the firm. So in essence, the interest of retained cash is taxed twice. Okay? Taxed at the corporate level and at the capital gains tax level. Okay? So for every piso, matatax yan by the two. Okay? If the firm paid the cash to its shareholders instead, they could invest it and be taxed only once, based on tax on dividends, on the only tax on the interest that they earn. Okay? So the cost of retaining cash therefore depends on the combined effects of the two. They are counteracting actions. So here, T star retain refers to the cost of retaining cash, and therefore it depends on the combined effect of the corporate and capital gains taxes compared on the single tax on interest income. Okay? So if 1 minus TC times 1 minus TG is greater than 1 minus TI, what happens? Okay? This is greater than 1. Okay? And therefore this is negative. So therefore the cost of retaining cash is so big. And therefore you should just issue it as dividends. Now, dividends and distress costs and agency costs. So generally, firms retain cash balances to cover potential future cash shortfalls. Okay? So a firm might accumulate large cash balance if there is a reasonable chance that future earnings will be insufficient to fund future NPV projects. Okay? The cost of holding cash to cover future potential cash needs should be compared to the reduction in transaction cost, agency, and adverse selection cost of raising new capital through new debt or equity. Okay, so holding excess cash reduces distress cost, right? Because it gives you the financial flexibility to save distress costs away. And again, the impact is negative leverage. So we know that if the impact is negative leverage, it reduces distress cost. Okay? When a firm have excessive cash, managers may use the funds inefficiently by paying excessive perks, overpaying, etc. And therefore, it increases agency cost. Okay? Firms should choose to retain some cash to help with future growth opportunities also, and to avoid financial distress costs. So here, we're saying that high retention of cash, okay, lowers distress cost, but it also increases agency costs. Okay. What lowers distress cost? Lower debt, right? What increases agency cost? Lower debt, right? So cash retention, okay, is also equal in terms of impact to deleveraging. Okay? Diba pareho ng impact? If you retain cash or you don't pay dividends, it's equivalent. The equivalent impact is deleveraging para ka nagbabawas ng debt. Okay? Right? Which makes sense. If you don't declare dividends, your equity remains the same. If you declare dividends, your equity is reduced by the amount of dividends. If your equity is reduced, therefore your capital structure becomes more debt heavy. So dividend payment has the same impact as increasing your leverage. A dividend reduction or zeroing out dividends has the same impact as deleveraging, reducing the impact of leverage. Okay. So let's have this example. Okay. Dividends and agency cost. So the company is an all-equity firm with 100 million shares outstanding. Rexton has 150 million in cash and expects future free cash flows of 65 million per year. Management plans to use the cash to expand the firm's operations, which will in turn increase the free cash flows by 12%. If the cost of capital is 10%, how would you decide? Okay? So basically, you want to check the market value. no, of the firm. Okay, remember, we're dealing with an all-equity firm, so value of equity is equal to value of the firm. Okay? So if Rexton uses the cash to expand, its future free cash flows will be higher by 12%. So it will be 65 million times 1.12, 72.8 million per year. Using the perpetuity formula, the firm value will be 72.8 over 10%, 728 million, or 7.28 per share. Okay. If the company does not expand, then the future cash flows will remain at 65 and the firm value will be 650. However, you have to add the value of cash, which is 150 million. Okay? And therefore, the market value is 800 million. So therefore, 8 per share higher. So therefore, B versus B is better. Right? Let's look at C. If there is a repurchase, okay, there will be no change in the share price also. Why? Because what will be the repurchase? 150 million. Okay. Then the price per share is 8 per share. Okay, so therefore, you can buy 18.75 shares outstanding. Saan nanggaling yung 8 per share? The status quo. The status quo is 65 million over 10%. Okay. That is equal to 650 million plus 150 million over 10 million shares. So therefore, 150 million of cash. Therefore, $8 per share is the status quo value, right? So that's why the purchase price here is 8 pesos per share. With that, you can buy 18.75 million shares. Okay? So with that, the firm value would now be $650 million. Wala na yung cash, nabili na eh. Pero the denominator will be 81.25 million shares, which is 100 million shares minus the amount that you bought, which is 18.75. Okay. You arrive at $8 per share. Okay. So with this, you know that well, B and C is better. B and C indifferent, same amount. Okay. But where is the agency cost here? The agency cost is that management might recommend B. Why you can recommend B? Because it will increase cash balances and therefore increase future cash for empire building. So actually, if you use B, the future cash flows might not be 65 million, right? Why? Because the excess cash might reduce cash flows in the future. Because those cash flows are due to empire building, overpayment, etc. So ultimately, C might be the best case here. Okay. So in terms of letter A, why did the value decrease to 7.28 million? It's because the new investment opportunity is NPV negative. Okay. So that's negative 150 million plus the cash flows to perpetuity, which is 65%, 65 million times 12% over 10%. So if you get that, that's minus 2.72. Minus 0.72 per share. Okay, which is equivalent to the difference here of 72.8 million in the status quo, which is 8 million per share. Okay. Now, similar to capital structure policy, dividends also have a signaling or information content. Okay. So one thing that you will see in literature is that, and in practice also, there is so much dividends moving in practice. What does that mean? They maintain relatively constant dividends. So this is General Motors. Okay. So from 1985 to 2008, you look at dividends. Dividends are actually smooth, but earnings are volatile. Okay. However, changes in dividends signal significant changes in earnings, right? Here, for example, there was an increase of dividends from in this time period. It signaled higher earnings. There's an increase in dividends in this period. It signaled higher earnings. Okay, constant, but there was a reduction here, 2015. What did it signal? It signaled lower earnings. Okay, so therefore, if you look at the market, dividends have information content, particularly changes in dividends have information content. If you look at it, if you inspect it visually, it's quite obvious that changes in dividends lead to something, right? There was a significant change in the performance of General Motors, after changes in dividend amounts. Okay? So therefore, that is something that is worth looking into. Okay? Research has found out that management believes that investors prefer stable dividends. Okay? Management desires to maintain a long-term target dividends as a fraction of earnings, and thus firms raise their dividends only when they perceive a long-term sustainable increase and cut them only as a last resort. Okay? So dividend signaling hypothesis. Okay? The idea that dividend changes reflect managers' views about the firm's future earnings prospects. Okay? Because they don't want to raise a lot of questions from their shareholders. That's why they want to have a constant capital structure, constant dividend policy. Right? However, if there are changes in dividend policies, it means that they have serious conclusions about the company. Okay? So if firms smooth dividends, the firm's dividend choice will contain information regarding the management's expectations of future earnings, okay, and the troubles of the company. Okay? When a firm increases its dividend, it sends a positive signal to investors that management expects to be able to afford a higher dividend in the future. And by contrast, when a firm decreases its dividend, it may signal that management has given up hope that earnings will rebound in the near term. Yeah? Although an increase in a firm's dividend may signal management's optimism, it might also signal a lack of investment opportunities. Okay? Kasi di ba kanina we mentioned that the decision was to uh, retain dividends or pay it out. When you retain it, you want to invest it also. And increasing the payout may signal lack of investment opportunities. Okay? So it might also be negative news. Right? Conversely, a firm might cut its dividend to exploit new NPV positive opportunities. In this case, the decrease might lead to positive rather than negative stock price reaction. Okay? But actually, ito yung mas prevalent sa market, these two. But of course, these literatures can also be considered or tested in the market. Okay? Share repurchases also have some signals. Share repurchases are a credible signal that the shares are underpriced. Because if they are overpriced, a share repurchase is costly for current shareholders. Okay. Investors believe that managers have better information regarding the firm's prospects, then investors will react favorably to share repurchase announcements. Okay. Now, if there's news cutting dividends and doing share repurchases instead, is this good or bad news? I'll interpret this as bad news. Cutting dividends means and replacing them with share repurchases may mean any of the following. Okay. Number one, may mean that there are no long-term dividend sustainability. Hindi na niya kayang mag-pay ng dividend sustainably. So opportunistic na lang based on repurchases. Okay? I can also interpret it that stock prices are undervalued. Okay? So therefore, it depends on the company on how the market will react. Stock dividends, stock splits, and spin-offs. Okay? Now, stock dividends, with a stock dividend, a firm does not pay out cash to shareholders. Okay? What's important to notice is that the market value of the firm's equity should remain unchanged. Okay? The market value meaning total value. The price per share might change, but the total value will remain constant. Okay? So stock price will therefore fall because of the same total equity value is divided by a larger number of shares. Okay? So here, suppose the company paid a 50% stock dividend, okay, rather than a cash dividend. So a shareholder who owns 100 shares, okay, has a portfolio value of 4,200, still at 42 per share. Okay. After the dividend, the shareholder now owes 150 shares. Because the portfolio is still worth 42, the stock price will now fall to 28. 42 over 150 rather than the previous 42 over 100. Stock dividends and stock splits. Stock dividends are not taxed. So from the both firms and equity perspective, there's no real consequence to a stock dividend. Okay. The typical motivation for a stock split, on the other hand, is to keep the share price in a range thought to be attractive to small investors. Sometimes, masyado nang nagkaroon ng sobrang laking capital appreciation na if you want to clientele effect again, if you want to attract certain type of investors, you do a stock split para bababa yung market price because there will be more shares suddenly. Okay? Keeping the price, if the share rises too high, it might be difficult for small investors to invest. And you need the liquidity, right? I mean, involving the retail investors and having them engage in the stock market or considering your stock keeps the liquidity of the stock going and therefore keeps pricing going. Okay? So it's also important to put them in or to pull them in into the market. And keeping the price low will make the stock more attractive to small investors and increase demand and liquidity of the stock, which will in turn boost the stock price. Okay? A reverse split is when the price of a company's stock falls too low and the company reduces the number of shares outstanding. So if you reduce the number of shares outstanding, the price will go up because it's the same value over a smaller denominator. Spin-offs. Okay? A spin-off is when a firm sells a subsidiary by selling shares in the subsidiary alone. Okay? Non-cash special dividends are commonly used to spin off assets or a subsidiary as a separate company. So if you can imagine, if this is the parent, there is a subsidiary. The parent owns 1,000 shares of the subsidiary. The parent has 1,000 shareholders, 100,000 shares outstanding. Okay? What the parent can do is declare a property dividend. Okay? Declare a property dividend and distribute these 1,000 shares to the 1,000 shares in subsidiary A. Okay? Then distribute it to the shareholders of the parent. So mawawala na yung subsidiary A dito. Ang may-ari na yung 1,000 shareholders of parent company. So in effect, you're able to spin it off without selling it. Okay? What's the advantage of this? It avoids transaction costs, okay? And it's not taxed as a cash distribution. Okay? However, of course, hindi naman, of course, yung sinabi ko is parent, subsidiary A. Okay? Siyempre, mahirap naman imagine yung may 1,000 shareholders, diba? So, the more practical application here is if you want to change the parent of the company, if you want to bring it in the higher level of the organization. So, for example lang, okay, This is not a true transaction. So Manila Water, for example, there is a Ayala is here. Okay. There is a subsidiary, there is an intermediary between Ayala and Manila Water called Water. Okay. So MWC is directly owned by Water. Water is directly owned by Ayala. Okay. Now, kung gusto kong diretso na si Manila Water kay Ayala, what are my options? One option is Water sells MWC to Ayala. Right? So, malilipat na doon because of the sale. Right? But another option is Water can distribute Manila Water shares as dividends to Ayala. Okay? So, if that's the case, yung investment in Manila Water that is in the books of Water will be distributed as dividends to Ayala and therefore will be in the books of Ayala. So because of that, what happened? Because of that, wala na dito yung Manila Water. Manila Water is now a direct subsidiary of Ayala. Magka-level na sila ni Water sa corporate structure. So you can also do that by dividends. Now, what are some practical dividend policies of corporates? Okay. Some corporates have a stable dividend policy. What's a stable dividend policy? The goal is to have a steady and predictable dividend payout per year. Okay. So even when the earnings are up or down, investors receive a dividend and it is the same amount, say $2 per share. Okay. So regardless of earnings volatility, a stable dividend policy might say that the dividend policy is $2 per share. Okay. So there's more certainty concerning the amount and timing of the dividend. Okay. Most companies are like this. No, not most, many companies. I'm not sure kung most. So many companies are using this. Okay. So consistent lang. Basta $10 per share tayo every year. Okay. So that's a stable dividend policy. There could also be a constant dividend policy. Okay. Constant dividend policy. Okay. What is the drawback of the stable dividend policy? Investors may not see a dividend increase in boom years. Okay. Now, if you want to also feel the impact of growth, if you want your shareholders to also ride the growth of the company, then there could be a constant dividend policy, wherein by constant, we mean constant percentage of earnings. So as you can imagine, the proportion is the same, the proportion is constant, but every year the amount changes. Okay. So the company pays a percentage of her earnings of dividends every year. So in this way, investors experience the full volatility of company earnings. Okay. So the problem, of course, is financial planning on the part of the investor because you don't know what your dividend amount will be. Another is residual dividend policy, wherein there's no constant percentage, but it depends on the amount of residual cash flows. Okay. But so residual dividend policy, the company pays out dividends after payment of everything. So parang meron kang revenues, di ba? Basta nabayaran ng OPEX, nabayaran ng CAPEX, nabayaran ng debt service for that year, any residual is the amount that is being paid out as dividends. As you can imagine, that percentage of earnings will change year by year. Okay. Of course, it is volatile. That's its drawback, but it makes the most sense in terms of business operations. Okay. Investors do not want to invest in a company that justifies its increased debt with the need to pay dividends. Of course, there could also be irregular dividend policies. No? I mean, can be zero, can be positive, without any strict rule. No? That's also a choice. It could also be no dividends. No? Doesn't distribute dividends at all. No? And probably it's because the company is number one, may have a negative retained earnings, therefore not eligible to pay dividends, or the company is investing too much, investing in growth. So therefore, they have a lot of NPV positive opportunities to fund, and therefore maximum retention is needed. Okay? So that's why they have a dividend policy. Now, what are some real factors favoring high dividend policies? Okay. Now, design for current income. You know, the classic example is the group of retired people and others living on a fixed income. Okay. So the argument further states that individuals with bid at the stock price should dividends rise and bid at the stock price should dividends rise. In other words, this is also an extension of the client benefit. Right? There might be a segment of your investor base that desires current income. Right? So therefore, putting or therefore going by their dividend or payout preferences might be the better option than your significant shareholder base. Okay. Agency cost, high dividends, discipline management, similar to the impact of debt, and signaling information, signaling content. No? So high consistent dividend signals strength to the market. Okay. So if you notice, high dividends has the equivalent of high leverage, right? In terms of agency cost, okay, and in terms of signaling. Low dividends has the impact of similar to low leverage. Now, what are some real-world considerations between dividends and share repurchases? Number one is flexibility. Okay? So firms often view dividends as commitments to their shareholders and are quite hesitant to reduce an existing dividend. Repurchases do not represent a similar commitment. So for example, yung kanina example natin, for example, meron kang regular dividends sa $2 per share. But this year, you have excess cash, wala kang investment opportunity. So you want to add more dividends. So ko na rin sa shareholders ng iba. But I don't want to increase my dividends because it might be perceived that I'm willing to pay additional dividends from now until the future. Right? When in reality, this year lang naman ako may windfall. And since this year ka lang may windfall, baka better na $2 per share pa rin yung dividends, but you will do a share repurchase. Since investors do not perceive that as a long-term commitment to have that kind of repurchases regularly. Okay? So you might opt for repurchase to maintain flexibility in your dividend policies. Okay? Executive compensation. Existing stock options will always have greater value when the firm repurchases shares instead of paying a dividend, because the stock price will be greater after repurchase than after a dividend. Okay? Assuming market values are constant, right? Then having a repurchase increases the stock price. The stock price increases, but remember the total value is constant. Okay? And since if the stock price is higher, there is more volatility and the value of stock options are higher. And therefore, since there is an impact on executive compensation, share repurchases also have agency costs. Okay. Another consideration is undervaluation. Many companies buy back stock because they believe that a repurchase is their best investment because their shares or the stock in the market is temporarily depressed. Wala silang ibang mapagbigyan ng cash. So, i-buy ko na lang yung shares ko, i-issue ko siya at a higher price. And of course, taxes, which we have extensively discussed. The purchases may provide better tax advantages to shareholders. Now, just as a recap of everything about payout policy, okay, what are the concepts that we have um, understood? Number one is, according to Modigliani and Miller, it's similar to capital structure policy, dividend irrelevance. Okay? Dividends and dividend policy or payout policy does not matter. It does not change firm value. And so therefore, we don't need to think about dividends. Okay. Second key item we want to highlight is the financial effect of taxes. Okay. In reality, for you to raise funding, you need to attract investors. And you have to know how to target what kind of investors to attract. And sometimes the dividend policy influences the kinds of investors that are going to invest in your company. And so you can use dividend policy to lure or attract certain kind of investors that will strengthen your investor base. Okay. Corporations usually they will have a preference for high payout stocks, taxpayer institutions, medium payout stocks, and individuals in low tax brackets will have low to medium paying stocks and high tax brackets, zero to low paying stocks because they would they would like to have share repurchases instead. Okay. Now, dividends have an impact on agency cost similar to leverage. Okay. Because dividends provide discipline to management, and so therefore it reduces agency costs related to empire building and inefficiencies. Okay. And dividend and the purchases lastly have signaling effects. And the signaling effect is similar to the impact of leverage. Okay. Because changes in payout policies are in effect uh, impact also in capital structure. Okay. So higher dividends means higher leverage. Lower dividends is equivalent to lower leverage. So in terms of the signaling effect, it's very similar. Okay, that's it. Thank you.